What's going on, guys? It's Jimmy here. We're going to go over today what just was announced here by the Fed and is going to affect all 50 states here. And the US dollar is plummeting. We're going to go over why your US dollar, why your money is actually worth less and is continuing to happen here, and what to do about it here in this video. Yeah, so let's jump right in. All we hear about lately is this looming recession. Banks seem to be failing left and right. The stock market has been very volatile, up hundreds of points one day, down hundreds of points the next day. Inflation is crazy high right now. Gas prices are on the rise yet again. And the global economy is a very uncertain place. Economic experts fear a repeat of the 2008-2009 economic crisis and the crash that we had when retirement portfolios were basically cut in half. But there's a way you can protect yourself against devastating recession and crippling inflation. In an economic environment like the one we're in right now, people can recession-proof their money by diversifying into gold and silver. Gold and silver are considered hedges against recessions and inflation, and actually tend to rise in an uneven economy. For example, in the 2008 financial crisis, when stocks plummeted, gold surged in value by about 50%. So now more than ever is the time to call the precious metals dealer that I trust, American Hartford Gold. They'll show you how to protect your savings and your portfolio by diversifying with physical silver and gold. American Hartford Gold has thousands of highly satisfied customers. In fact, they're the highest rated firm in the country with an A+ rating from the Better Business Bureau. That's right, so you're in good hands with them. And as a special gift to my viewers, American Hartford Gold will give you up to $5,000 of free silver on your first order, which is amazing. So call them now at 866-349-3628 or text Jimmy, Jimmy, to 65532. And don't forget to mention I sent you to claim your free silver with your first order, which is amazing. Okay, let me show you what happened here with the announcement here today with the inflation report and what the Fed might follow up with here. Start with this.
Data to bring you. That's right. Inflation fell by more than expected in March to 0.1% from the previous month and 5% on the year. So let's break down what this all means with NBC News business and data reporter Brian Chung and Investopedia's editor-in-chief Caleb Silver. Good morning to you both. Big news. So Brian, let's start big picture. Walk us through what these numbers are showing and how they compare to previous months.
Yeah, Zinkley, Ellison, the broad story is that inflationary pressures are still there, but they're alleviating a little bit. So when we take a look at the year-over-year changes in prices, if we look at March, the number came in at 5%. That's how much more things got expensive in March of this year compared to March of last year. And you'll notice that's a slower pace than the 6% that we saw in February of this year compared to February of last year. Again, this shows that prices are still increasing, albeit at a slower pace. Now, where did we see price pressures and where did we see not price pressures? Well, in the food category, some good news with changes essentially not between February and March, prices staying the same for all of those food categories at home and outside of the house. Energy prices continuing to fall, down 3.5% in the month of March. These are monthly comparisons, so this is actually compared to February. And then shelter, the cost of just putting a roof over your head, mortgages and rent staying expensive, but still actually slowing at a pace of 0.6%. That is a little bit lower than the 0.8% that we saw monthly in the month prior. So again, price pressures are still high, but again, to see that headline number coming down is certainly good news.
Okay, so Caleb, inflation pressure is still there, but alleviating a little bit. That's what Brian said. Is that your read on this data as well?
Yeah, it is. But you see the things that we pay for the most, food and shelter, we can't get away from that. Plus utilities, all of those things cost American households a lot of money. So while prices aren't screaming down, they are stabilizing a little bit, which could make the Fed decide to either pause or just maybe do one more rate hike in just 21 days and 5 hours. Not that I'm counting, but this is what we're watching for. How's the Fed going to respond to this? This looks like the interest rate hikes are working just super slowly.
early.
And let's talk about how this is impacting people's wallets. Brian, where are we seeing prices fall the most, and are there any areas where prices are still high or maybe even increasing?
Yeah, well, Caleb was pointing out that the things that we spend the most on, like food and like shelter, are still very expensive. But when you look at some categories like meat and eggs, those prices going down over the month pretty substantially. And we also saw that some of the travel categories, as people get out and get ready for summer travel, car and truck rentals went down, although airline fares remain very expensive. Actually, get this, between February and March, airline fares went up by 4%. So it could be very expensive to book a trip this summer.
Not a great time to travel.
Yeah, so as they mentioned, the Federal Reserve going to be meeting here in about 21 days, and maybe or maybe not going to be raising interest rates here yet again, which is just putting a crushing burden here on the average everyday American, with interest rates already at pretty much, credit card rates already at an all-time high. Just did a recent video here with the average credit card rate at 24%. Which is just crushing the average American. We have mortgage rates at 7% on average, which just a year ago they were below 3%, which is just making, again, anybody that needs to go buy a home or in a variable rate interest rate for mortgages, crushing people. We're seeing this across the board. You go to buy a car, a used car, lease a car, it's just absolutely crushing, adding hundreds of dollars to people's payments. So no matter where you go, whether it's credit cards, whether it's a car, lease a car, buy a car, a mortgage, you're paying hundreds or thousands of dollars more per month, no matter where it is. And then when you couple that with the US dollar, what is happening right now, and you can see here what actually China is doing against the US. China struck a deal with Brazil to ditch the US dollar and sending a message to the world to not trade in US currency. And this has helped to weaken the US dollar. You can see this headline here from Fox Business. You can see this other headline actually from Bitcoin.com. We're shifting to bipolar global reserve currency systems with the Chinese currency as an alternative to the US dollar. And you can see here from the South China Morning Post, after decades of US dollar dominancy, the global shift away from the dollar is suddenly picking up speed. And you might think these are just headlines, but they're not. Because when you look at this graph here of the US dollar versus the euro, this last 6 months here, you can see a dramatic decline. So look at 6 months ago versus the euro, we were actually above 1 euro to $1, actually 1.04. And you can see this absolutely dramatic decline on how much the dollar has declined versus the euro, one of the other world's most major currencies. But it's not just the euro. This is just the weakness of the dollar versus pretty much every other currency in the world. And look at this. I mean, 6 months ago, we were going up, and now the dollar is dramatically going down. And this is not good for the U.S. I mean, this in any way, shape, or form. We're having crippling inflation. Now our dollar is weakening and food prices going up. Now we're having gas prices go up, which if you look at the national average gas prices here, we've gone up 10 cents in just a week here. And in a month, we've gone up 15 cents. And you can see the pace is quickening here. And you got to kind of wonder here, we're going to go over $4 a gallon here on a national average here pretty quickly, how quick it's going up here. Diesel at $4.20 here on a national average. And yeah, it's really starting to pick up. And this comes after the OPEC Plus, which is Saudi Arabia and Russia, basically yet another bunch of more countries back in October, they announced a 2 million barrel plus per day cut of oil production for the entire world, raising gas prices back in October. So about a little bit over 6 months ago. And then here yet again, just a few days ago, announcing another million-plus barrel per day oil production cut. What this does is raises the price of gas and oil for the entire world. And what are we seeing here? Instantly, within the last week, gas prices already going up by 10 cents just in 1 week. So you can see the dramatic problems here that are already arising here. Weak US dollar, massive interest rate hikes, a weak economy, and it's going to happen here for the entire country. It's already happening. And the problem is food prices aren't going down, gas prices are going up, interest rates are high, and we have basically a massive war in Ukraine that is not going away anytime soon. You let me know your thoughts in the comments. How does all this get fixed? I'll keep you up to date here. If you haven't yet, make sure to subscribe down below to our YouTube channel. It's completely free to do so, which is pretty much the best price you can get. Click the bell icon after you subscribe, and thanks for liking and sharing these videos. And don't forget to check out Hartford Gold down below in the pinned comment or the description of this video. Thanks for watching, guys, and I'll see you in the next video.